Welcome to Swapskills financial markets videos, showing you what you really need to know. Interest rate swaps are used equally by financial institutions as well as corporates. They're a key instrument in the financial markets. So what we're going to do in this module is to look at some of these uses. One use is how to manage basis risk. Now, when you hear the word basis, mentally substitute the word index. So, for example, a mortgage lender runs basis risk if he borrows on a floating or variable rate basis and lends on a fixed rate basis. As long as his borrowing costs are lower than where he lends money out, he will obviously make a profit. Now, the banks or mortgage societies, for example, have a group called ALM, which is the Asset and Liability Management Team. They're responsible for managing the risks of borrowing and lending. So where do you get your money from? What interest rate should you pay on it? Now, when short-term interest rates, where they can borrow, are lower than long-term rates, where they're going to lend out, they call it 363 banking. In other words, you borrow at 3, you lend at 6, and then you're on the golf course at 3. So great, easy money. But what if interest rate costs start to rise every week or every month? Remembering that the loan on the other side is fixed and cannot be changed for, say, another 5 or 10 years. This is where they might look at doing an interest rate swap. It simply means that any floating rate payment on the money they're borrowing, whether it's 1% or 1,000%, will be matched by the swap counterparty. In return, the mortgage lender is going to make them a fixed rate payment. So he's completely immunized against short-term interest moves. As long as he receives in a higher fixed rate on the loan than he's paying on the swap, then he's locked in a profit. The dilemma that the ALM desk has is that long-term rates are typically higher than short-term rates. So by moving down the curve, as we say, and paying fixed, the ALM desk is losing the opportunity to earn an extra amount of net interest income. They will normally figure out the optimal mix between fixed and floating, looking at their earnings at risk in case interest rates do start to move against them. Okay, well, what about project finance? Now, a CFO or Chief Financial Officer may have 10 people knocking on his door, but only enough capital for 4 projects. Now, when you evaluate projects, you normally discount the forecast cash flows back to a present value at the rate of return you require for the risk of that project. Well, this rate of return you require can be pretty subjective for more difficult areas like Afghanistan in this example. In Europe, there are probably enough other projects that you could roughly work out what's the right rate of return for a project of similar risk. But in Afghanistan, who knows? Well, since margins might be tight, the CFO will lock in as many variables as possible that might affect the profit margins. So this means commodity price risk, funding risk, and of course, interest rate risk. Well, now for a really interesting scenario. What if you're not 100% sure an interest rate risk will arise? Now, unless you're absolutely sure, you want to consider using an option. This gives you the flexibility to walk away from a deal and not be stuck with it. Examples might include an acquisition or a project which fails to go ahead, but where the potential financing costs are hedged before the deal going ahead. Now, an example of this is Harvard, the renowned college in the States. In anticipation of several projects for which it had lined up funding, Harvard entered into some interest rate swaps. We then moved into the financial crisis, which resulted in many of the projects being postponed. So this meant that no funding was forthcoming since no projects were happening. So Harvard had a problem. It was sitting on swaps it didn't need and that weren't hedging anything. Even worse, rates fell sharply, so Harvard was stuck with paying high rates while offsetting swaps were much lower. So, for example, if you're paying 5%, but interest rates are now down at 3%, you've got a problem. Well, the banks were asking Harvard to put up money to cover these losses, but their investment portfolio was now underperforming, and liquidity, or cash on hand, was scarce, so a sort of double whammy. Remember, we're in a credit crisis here, so credit spreads are bad, your bond portfolio is not looking so clever, and the equity markets are down. Well, it cost Harvard nearly $500 million to close these out. and in addition they agreed to pay another $425 million over the next 30 to 40 years. What the clever guys in Harvard should have done was use options to enter into swaps. So when the underlying deals fell away, they would only have lost their option premium. Okay, let's look at covenants now. These are red flags in loans which warn the lender if the borrower may be experiencing financial difficulties. If a covenant's breached, then technically the lender has the right to call the loan or ask to be repaid early. In reality, the bank would try and work out what was going on before pulling the plug. A typical covenant is the interest coverage ratio. If I lend to you, I want to know that not only can you repay the loan, but you can also service it. I want to know that for every $10 of interest cost or expense, for example, you can cover this several times over. So if you've got $50 of free cash flow and $10 of interest expense, you've got an interest rate coverage ratio of 5 times. Now, in some cases, a bank may actually insist that the borrower put some sort of hedging in place, particularly with larger loans. Okay, finally we come to bond portfolios. A bond is simply a bit of paper that says that a borrower promises to pay back certain cash flows and principal at the end. Bonds would typically be fixed rate, but there are many variations. Interest payments are called coupons. Now this relates back to the days when interest payments were claimed by handing over a coupon in return for cash, and you can actually still get this with bearer bonds. So why do bond prices go up and down then? Imagine you have a bond that pays you 5% a year. Now, a second after you buy it, you realise you should be getting 6% a year instead. Maybe interest rates have risen and other bonds with a similar risk profile are offering 6% now. Or maybe you realise that the issuer's no longer the credit risk you thought he was and you want a higher return. Either way, you want an extra 1% a year for the next 5 years. Since the coupon is fixed and can't be changed, what will happen? Well, I can't physically come round to your place each year and give you the extra 1%. So instead, what we will do is discount this extra 1% a year that you want back to its present value. Now, basically this means looking for how much money you would need in the bank today, where, if you could earn interest on this, it would be enough to generate 1% a year for the next 5 years. Now, if interest rates were 0, the present value would be 5%. 1% a year for 5 years, that's 5%. And if interest rates are 0, you need 5% up front. If interest rates are a bit higher, then obviously you don't need 5% up front. Well, in this instance, you can work it out either by hand with a formula or with a financial calculator. Now in this example, I've worked out the present value of 1% a year for 5 years is 4.2%, or $4.2 if you're looking at bond price. So economically, you should be indifferent whether I give you $4.2 today, which you can invest, or $1 a year for the next 5 years. This then is the discount on the price of the bond. So instead of charging $100, the face value, I'll drop the price by $4.20 and charge you $95.80. So although the bond only pays you 5%, this growth in your initial investment from $95.80 to the $100 redemption value at maturity is giving you the extra 1% yield you're looking for. So how could the investor have protected himself against price risk? He could have paid fixed on a swap. So if interest rates go up, it's not good for your bond position, which is now going down in price, but you should be making on the swap. So if you had paid fixed at 5%, but now rates are at 6%, then you're in good shape. And hopefully what you lost on the bond is offset by what you've made on the swap. Well, this gives you an idea of some of the regular uses of swaps by both liability managers and asset managers. Keep watching Swapskills.com for more information on other financial market instruments and their applications.